there's a set of ratios we've already talked about that have to do with meeting your current liabilities. How much coverage do you have to pay your current liabilities? We have the least stringent that we already saw was the current ratio, which takes all your current assets and it divides it by the current liabilities. Okay, so that's the most permissive because you're not differentiating within your current assets which ones are liquid, which ones are less liquid. You're just taking all your current assets. Okay, now the most stringent, meaning the most strict, is the cash ratio, where you just of your current assets, you just look at cash. How much cash do you have to cover your current? Sorry, this should be current liabilities. This is the most stringent because you have all these different current assets, but you're just looking at the most liquid. Now, a middle ground is the quick ratio, which is what is covered in this chapter, where you take your cash equivalents, short-term investments, and AR. The big one that's not included in here is inventory. Okay, because as we saw, like with Restoration Hardware, some businesses, it takes them a while to sell their inventory. It's not as liquid. Okay, so this middle ground strategy is using the more liquid parts of your current assets to see how much coverage of your current liabilities you have. So it's like kind of a middle ground. Okay, so this is really measuring how quickly you're collecting your account receivable. Okay, so you want to see basically how many times that this cycle of extending credit and collecting the cash can happen in a period. And so you're looking at the amount of credit sales that you make in the period as a function of how much accounts receivable balance you have. So it's another one of these turnover ratios. It's a similar thing where you see what the total kind of volume is compared to the balances at the beginning and the end of the year. Okay, so this average net accounts receivable, you take your beginning account receivable balance and your end account receivable balance, find the average, and you compare that to your total credit sales. So let's say you had $100 million in credit sales and you have whatever, $1 million in average account receivable. That means you're collecting the cash very fast because look how low your account receivable balance is compared to the total credit sales. It means that you're generating a ton of sales and the cash cycle is really short, right? You make $1 million of sales, you collect the cash, you make $1 million of sales, and by the end of the year, or the average, you only had $1 million of receivables. Okay, so this is a very fast cash cycle. Okay, and then the opposite is, let's say you had $80 million in account receivable. That means that you're like still lingering, right? You made a bunch of credit sales, but a lot of that is still sticking around in accounts receivable. Okay, so your cash cycle is very long. Okay, so another way to kind of visualize or like understand this is you do this turnover ratio, and if you divide 365 by that ratio, you get the average number of days it takes to collect the cash. Okay, so this is maybe a more intuitive way to understand this ratio. It's like how many days does it take from the time you extended the credit to the time you get the cash on average? And so days sales and receivables will kind of tell you that.